Hey, what's up, ladies and gentlemen? It is Friday, our favorite day of the week, Financial Friday. We're here, we're clear, and we're on the air. So, per the usual, hey, like, love, share. We do this for you guys every Friday. We're going to be here to talk about real estate, what's going on in the market, how to protect your retirement, stocks, so on and so forth. But before we get started, there are two things you need to know. First thing is, these are our opinions, okay? So like don't run off and be like, "Oh, I sold all my stuff because Glenn, Rico, and Cam said to." I hold no responsibility, neither do they, as far as your decisions. These are strictly our opinions. We do this so we can help educate the masses because we feel as though there's just not enough information out there that people are able to take advantage of so they can be educated about their money. Rule number two, every week we switch off who picks the articles. This week is going to be Glenn. So that way you guys can get like a holistic kind of all around view of where our minds are at when it comes to the market, finances, so on and so forth. So as we rock into it, what's up, gentlemen? How are you guys doing today?
Great, man. Feeling good. Feeling great. You said Fridays are the favorite day of the week. Every day for me is the favorite day of the week.
This guy.
I'm
No.
listen. I'm not even. I can't follow Glenn. Friday is definitely my favorite day of the week. Every day of the week is not my favorite day of the week. Friday is definitely my favorite day of the week. And I'm excited, man. Yo, Glenn he's such a great guy, man, and it's genuine. I want people to know that it is genuine. And with me, my whatever you call it is genuine too. So let's get into it.
I promise. I promise. I promise.
I promise.
Glenn, as I pull up the article for today, please talk
Yep.
about why you chose this particular one to start with, and then we'll get into it.
Yeah. So first of all, Cam, I know you're out in Georgia right now. It seems like it doesn't matter podcast, Financial Fridays, wherever you are, that lighting is always solid.
Grade A, baby. Grade A. I
I
got a
got
kit. I got a kit that I
I gotta
bring everywhere with
I
me.
gotta upgrade my lighting, man. But no, seriously, for those tuning in today, uh, thanks for tuning in. So this particular article, so there's a couple articles I chose, but this in particular, I chose because a lot of people are hearing the word retirement right now, like
Mhm.
retirement. I feel like I hear more people talking about it now just because of what's been going on in the market. People losing money or people who have lost money in their retirement in 2022. Averaged 22% of their hard-earned money, and right. And so, regarding the required minimum distributions, I feel like there's still a lot of people who are not up on the Secure Act 2.0, right?
Yep.
And so, this particular article kind of like encompass that. So I thought it'd be good to kind of again remind folks of what's going on regarding the RMDs or the required minimum distributions with that. And something that really inspired me to kind of pick this was because kind of reading this past week, it was something that was said is one in three workers cash out their retirement accounts when leaving their jobs.
Mm.
So the reason why I wanted to kind of touch on this is because when people are going from one job to the next, as far as like whether they're trying to roll over their 401k or roll over their IRA into their new job or the new business, when I read that the one out of three workers cash out their retirement account, like that's a problem, right?
Yeah.
And I wanted to just kind of talk about that in a sense, but because generally when you're setting up a retirement account, it should be for the focus should be just for that, right? It should be to
Yeah.
actually at some point I plan on retiring, hopefully being financially free, or whatever your goal is when it comes to retirement. But like if one out of three people are actually cashing out their retirement, like I said, that's a problem. So number one, for the folks that are continuing to start up retirements or continue to contribute to their retirements, I wanted to kind of have this conversation regarding this article, right? And so in this article, it talks about a lot of people who are changing the actual jobs. The retirement account is supposed to be focused on just that, right? And so even
Yeah.
the folks that are contributing, because some people are like, hey, well, if I'm contributing, what portion of my income should I be contributing to my retirement? right? And so
Yeah.
obviously that explanation is for, is different for everyone. But one of the main things that I've found out in this industry, as far as being in the financial industry, is that if your employer is only matching you 2%, if your employer is only matching you 5% or 7%, et cetera, as far as your contribution, it should match what your employer is going to be matching you, because there are other vehicles where you could be reallocating some of those funds, right? I know I had a client in the past who was contributing a significant amount of their monthly income, and their employer was only matching them 3%, right? And so essentially, it's just, and I've heard Jeremiah Rico talk about this before, as far as like when it comes to, it's just like free money you're giving away, right?
Yeah.
Is it the smart thing to overfund your retirement if your employer is only matching, right? Especially knowing that there are other financial vehicles out there that are safe, that you can still, potentially get the upsides of the market, and don't have to worry about the downsides, right?
Yep.
And so that was something that kind of stood out to me. As you have it right there where it says, what are RMDs? For those that don't know what the required minimum distribution is, in that particular paragraph, it says that, you don't pay taxes on money in your IRA or 401k. They're tax advantaged, right? Instead, you pay when you actually withdraw those funds in the retirement, or at the age of retirement.
Yeah.
And so it dives into talking about the Secure 2.0 Act. There was an important provision that took off 1 January of this year, right? That basically delays until the age of 73, right? When account holders, they must actually start taking their required minimum distributions from their actual retirement. And so I have a couple more things I want to kind of highlight, but I'm a pause there, because I know I just kind of fire hose the call with all that information. So just to kind of unpack that. But what are you guys' thoughts on this particular article and the requirement minimum distribution?
I'll let Rico go. No.
Go ahead, Kim.
So when it comes to the RMD, so the first thing I always tell people is that the reason they changed it is because they want you to work longer. I mean, there's a whole reason that they upped it. They didn't up it. Once again, like I always say, the government does not change rules that help us, that they change rules that help the government. And so in retrospect, they extended the age of RMDs, not because they were giving you an opportunity to save more money. They're giving you an opportunity to work longer, because they know the current system in place does not work. And so you're not going to be able to stop working realistically until you're in your late 60s to early 70s. And by the way, by the time that people who are, anywhere between 30 and 45 years old, by the time you get to 65 or 70, the age will probably have increased at least once or twice again.
Yeah.
So that's what I got.
I was talking to a client the other day. They're 58, and don't necessarily have a healthy retirement, and so I'm hearing more and more clients say, at that age, say, my plan is to keep working until I'm 70 something. Like for me, and this is no judgment, but like for me, those are the years I want to be enjoying time with my grandkids. Like I want to, be attending their little recitals or their sporting events and different things like that. And it's like, sadly, this has become like a common conversation for folks that are, late 50, early 60s, and they're still like, okay, I plan on doing another 20 years.
Yep.
Like
exactly. And I'm just like, I'm not about that. Rico, what you got?
Man, working to 70 is never the plan, guys. I don't care who you are. The whole thought process behind working 40 years and just to retire on 40% of my, of my savings or whatever, however, that's not going to work. In a lot of cases, the reason why these late 50s and 60s, the reason why they're having to work to their 70 is because, well, they didn't reassess, right? We talk about here on this show all the time, guys, when it gets to a certain point, actually annually, you should be reassessing the way the market is changing, the way all these different things are occurring in the economic climate. You should be reassessing your retirement yearly, right? And so that's another thing. You might have set a plan in place 10, 15 years ago. It's not applicable right now because inflation is crazy, right?
Yeah.
And I'm with Cam on the RMDs. They're only stretching it. They're going to keep stretching it, guys. You don't get it. The more you work, right? That's more money going into that account. Here's the thing: the government they're telling you, hey, here's the deal we have with you. We're not going to tax you right now, but we'll tax you in some future rate, 25, 30 years later, and we'll get whatever it is then. Well, not only are you going to be in a higher tax bracket because the amount of money that you've accrued, if there's any interest or it's done well, it's going to be in a higher tax bracket. Well, it's just the sheer volume of the amount of money is going to be longer, right? It doesn't matter about when you're putting money in there, contributing. And so instead of them taxing you at a lower rate at your paycheck, they're going to tax you at a higher rate, right?
Yep.
And if I give you more years before your RMD starts, that means that I can have more money to tax you on. So like Cam said, they didn't change the rule to benefit you. It's actually so they can make more money, right? Yep. Oh, and then people our age, 30s, 40s, there'll be no Social Security when you get to that age. So you also have to put that. You also have to put that into the account right now when you're doing financial planning. I'll live on Social Security. You won't have it. Just to let you know, you won't have it. Yep. So we have to plan accordingly. Make sure that the money is there. I think this is a good article because it breaks down the Secures Act. I've been trying to tell people about it for a minute. People are like, no, there's some major changes in Secures Act 2.0 to effect December 22nd of 2021. 2022. Yep. And so now it's in full effect. People have to read it or get a breakdown or something, a compendium of it, so you can try to understand what's going on because it affects you directly if you're working.
And Rico, you hit on a good point. Like as far as the changes, like if most people who have 401ks, 403bs, traditional IRAs, rollover IRAs, and most small business accounts, these changes have impacted them, right? And so if you're one of those few, I would definitely encourage you to kind of read up on the Secure Act 2.0, just to make sure that if any changes have been applied for you, that you're still in the alignment with the direction that you want to move in when it comes to your retirement.
Mm-hmm.
So, and so last thing, so obviously the bottom line, this particular article, as we roll into the next, the Secure 2.0 Act, obviously gives you tax advantage. Or have tax advantage accounts. So basically having more time for your money to actually grow tax-free before you actually withdraw. And so here's 2 tips that I want to kind of pass on to anyone that's watching. Is tip number 1, when it comes to, if you're not very versed in the financial sector, like find or talk to a financial professional, right? And so, because they can assist you in that realm. And then the other thing, there are obviously retirement calculators out there. But again, if you don't know how to calculate things, it defeats the whole purpose, right? And so I encourage people who are watching to continue to take their retirement serious because so many people are being impacted today, right? Late 50s, late 60s, and they don't have time to recover. So, with that said, that was kind of the inspiration behind me choosing this particular article.
Bet. All right. So as I pull up article numero dos, the Charles Schwab
for watching and commenting. Definitely appreciate everybody watching today. We always like to hear people's thoughts, based off of the topics that we have as well.
We're going to do a session where we don't do any articles and we just do questions.
Yes. Yeah.
Mm-hmm.
Yeah.
Definitely. This article threw me off at first because I saw it was all black and white, and I was like, "Oh my god, my phone's broke." I can't tell Jeremiah though, because the first thing he's gonna say is an iPhone.
Right. 100%. 100%. I picked this particular article because generally when you talk about bonds, investments, banks, different things like that, a lot of people, hear the name Charles Schwab, right? Mm-hmm. And so this particular article, as I was reading it, the beginning part is a client, right? His name's Bob Thompson. He's been with Charles Schwab. He's been a client of Charles Schwab's for like 4 decades, right? And so what he was basically saying in the beginning part was, when I first, first couple of decades, I was a committed client to Charles Schwab, because of not only just their name, but because of what they stand for. And I've seen growth in basically my investments and different things like that. But he's like today, right? These last days, he has questions, right? And it says Schwab has been buffeted by the crisis. That engulfed U.S. banks since the failure of the Silicon Valley Bank, right? And obviously, we've talked about that on previous episodes with that. But I thought this was important because breaking down Charles Schwab, obviously is one of the banks, one of the largest banks in the U.S., right? And so with that, they have deposits of more than, I believe in the article it said, more than $300 billion, right? Charles Schwab is kind of like a one-stop shop where clients can essentially, invest, they can bank with, different things like that. So they have about 34 million clients, right? And so, Cam, can you do me a favor? Can you go to the bank graph?
This one? The
deposits
one?
Yeah.
Okay.
So just kind of looking at, 2019 quarter one to even like where we are Q1 or where we were Q1 of 2023, right? You can kind of see the ups and the downs of it. And so when I talk about, the deposits of more than 300 billion, the graph kind of represents that right there as far as quarter one. But you can see quarter one of just a year ago where it was, right? It was, nearly $450 billion. And right. And so as a client, right, as a client of Charles Schwab, that's stuff that you want to look at as an investor, right? The ups and downs of the actual company. And so I wanted to kind of highlight that as well. And then one other thing before I kind of pass over to you guys, and I have a couple more things to share because I had a lot of takeaways when I was kind of reading this one. The guy that I was referring to in the beginning, as far as Bob Thompson, he didn't freak out because the securities held at Schwab, right? So the stocks, the bonds, et cetera, and the bank accounts are protected by the FDIC up to 250,000. And so he was just like, I'm not so worried about, or wasn't so worried about before, but maybe I need to take a closer look. Even though I've been a client for 4 decades, things are shifting, right? So maybe clients' attention need to shift. So the problem is Schwab is currently borrowing money at a higher interest rate. Right. And so in the article, it talked about Wall Street was basically saying with that's not sustainable. Right. Up to date to like today, it has borrowed $45.6 billion in 2023. And so I'm going to pause there. Because I know you guys' wheels are turning.
So I'm gonna go with just this one right here where it says Schwab is shoring itself up by borrowing money at higher interest rates. Wall Street worries this can't be sustainable, just like Glenn said. And they, as you notice, that is in very big bold letters. I mean, realistically, as we know, when banks start borrowing money, there's a problem. Because what's the whole premise of banks in the first place? They're supposed to be borrowed from. So if the person who's supposed to be borrowed from is then in turn, what is it like? Borrow from Peter to pay Paul or something like that? I heard that phrase for the first.
Don't rob Peter to pay Paul.
Yeah, I mean, borrow, rob, whatever. I heard that phrase for like the first time, like
you're showing your age, man. That's
a year and a half ago. I don't know. But that's exactly what we're looking at, right? Is because at the end of the day, it's like the banking system as a whole, there's an evolution that's either coming or not coming for certain banks. And unfortunately, there's not a way to know right off top which banks are going to last and which ones aren't, right? Like, we were speaking earlier this week and we were talking about, the things that are happening, with the Silicon Valley Bank and stuff like that. There are banks in Japan that are being affected. That, this isn't just a United States thing. This is a banking system thing. And so it would behoove people to pay attention to kind of what's going on, especially with a bank like Charles Schwab. Okay, like Silicon Valley Bank, that most people I feel like hadn't necessarily heard of it, but because it's sitting in Silicon Valley, like, they had a lot of money from tech startups and stuff like that. But Charles Schwab, like, this is an organization that is, potentially known for being good with their money, and now they're borrowing it.
100%. Go ahead, Rico. What you got?
Same thing we say quite often. Be your own bank. You're trying to find out about that. Get with Cam. Get with Glenn. Be your own bank, guys. for years the banking system has been corrupt, right? This is I don't know. Everybody's like, oh, conspiracy theory. No conspiracy. I think what we're seeing now is blatantly, right, the failure of a system that has been failing for probably over 120 years, since the early 1900s, since they had the stock market crash in 29. I'm gonna be specific. Charles Schwab, probably with the greatest basis, right, greatest foundation of any bank, any actual investment firm. They bought TD Ameritrade, man. Like, you got to really like look at what this is indicating. Charles Schwab, they said, is like the Walmart of investing, basically. Now, here's the problem. The reason why, like Cam said, you're seeing a whole bunch of banks and a whole bunch of systems fail is because everybody's too generic, right? There's a bunch of general practitioners. There's not a bunch of surgeons, right? There's not a bunch of neurological specialists. There's not a bunch of oncologists, right? I'm using doctoral terms to get people to understand. Here's the difference. If you don't pick the right one, right, you could be a general, right, jack of all trades, but it's costing you now. And that's what's costing Charles Schwab, because people could always go and get cheap things, right? Cheap services. You could buy other people's stock through them. It was just all this. It's a Walmart, right? And that worked essentially. But even Walmart got affected when Amazon went online and streamlined some things. So this is what's happening to people. People are starting to say, hey, maybe I just want to be at a place that's more specialized, right? And so you see banks that are more just Goldman Sachs, they have some ups and downs, but they're specifically in the equities business, right? That's what they do. They're a bank, but they're specifically, we focus on investing. That's what we do. We're not trying to catch a whole bunch of different type of demographics. We know what our demographic is. We stick with it. That's our niche, and we roll with it. And so I think that's what people are starting to see. They want to get into something that's a little bit more individualized and tailored to them. And then also people are just waking up and realize banks suck. They don't really give you anything for the money that they're holding. So now you're having a movement of people saying, I can govern my own money better than you can govern it. And so why even let you have it? So that's what we see. That's where we're at.
Yeah. I seen Denicia had a question.
Who can you trust?
Who can you trust?
Yeah.
Rico kind of touched on it in the beginning, as far as like us, right? Not us as the three of us, but as far as like you being your own bank.
Yourself.
But at the same time, I think that it requires a level of taking ownership of your finances. And if people watching today don't take away anything from this conversation, please take away, start or continue to take ownership of your financial situation, right? Like we talk retirements. We're talking, like obviously people, have loved ones or the people that they love and they want to be financially free. Most people want to be financially free. What does that mean to you? Right? And so taking ownership of that is the first step, right? And it requires you to take research or do research. It requires you to actually seek out financial professionals who are fiduciaries, right? And so I wanted to kind of leave or respond to that question with that response. Great question, though.
Great question. All right. And as we pull up the third article, Glenn's workhorse.
So the last article, I think the last couple of times I've had, we're always reading stuff throughout the week, and I get inspired by some of the stuff you guys send me. And so this year, actually, I was reading on Thursday, Rico sent over, and obviously there's a lot of people who are invested in stocks. There are a lot of talk in stocks. Hey, do I invest in here? Do I stop investing? Based off of what the market is doing, based off of the high interest rates and different things like that. And so I thought this was a great one to kind of end the call on. At the first one at the top, I'm a fan of Meta, by the way, which is also why I kind of picked this one. Stocks rallied on Thursday afternoon despite the release of cooler than expected economic data as earning results from Meta built on a strong week of tech earnings. And so obviously that graph kind of represents the S&P 500, where it was 5 days ago and kind of, where it ended the week off. And so wanted to kind of just briefly highlight that for folks that are visual. If you could scroll down a little bit. Because it had a couple of things. So obviously, it talked about Meta. Meta shares closed the day up nearly 14%, right? So folks that are investors, or heavy investors, they may be looking at Meta, especially because they continue to hear that name out there with Microsoft and Google. With a lot of the AI stuff, going on in the economy, a lot of the talks. And so I wanted to kind of highlight that because for folks that are maybe interested in getting involved in stocks or just like reading about it, this was one of the highlights. Some of the other things that's going on in the economy, obviously, excuse me, we're picking up with travel season, right? People are investors in Southwest Airlines. So it talked about their shares kind of dipping 3.5%. Something else that I wanted to Lyft. So obviously people, Uber, Lyft, but Lyft specifically, I remember when I first heard about it a couple of years ago, I was thinking about investing in it, but I decided not to. But for those that are investors, their shares rose almost 1.5% this past week. And so the last thing, we often talk about like the real estate and things going on in the housing market. I think we talked about it a couple of weeks ago. I want to just kind of close out by highlighting that contracts to buy existing homes in the U.S. declined for the first time since November 2022, which declined 5.2% just this past month. And I know previously we talked about the applications dipping. This one's talking about the actual contracts to buy existing homes. So I wanted to highlight that just to kind of connect the dots from the last several weeks that we talked.
Yeah. So I posted something asking kind of like about, because I'm sure a lot of people have heard about kind of the new lending changes and how it's going to affect people with good or credit and things like that. And one of the things that a lot of realtors commented on when I posted about it was that more and more people are buying new builds because the new builds are offering, credits and all these other things that go along with it. And so that's why we're seeing, the wording on it is contracts to buy existing homes. Mm-hmm. So people don't, they're like, why am I going to buy this house that is, a couple years old that might need fixes? You're not going to give me any credits to fix anything when I can just buy this brand new house that comes with, a warranty, and they're going to knock down my interest rate for the first year, like all these types of things. Right. And so it's a market out there depending on where you're at.
Mm-hmm. Yeah, I agree.
I think the question with that would be, though, is that sustainable? Just like we talked about in the article last week, those new builders and developers are offering a lot of incentives, right? So free months, free utility months, knockdown interest rate is only at 4%, 3%, 3.7, all these incentives, but it's not sustainable. If you do that over a long haul, right, you can't keep doing that because then you suffer profit margin loss as a company. And you're just, and if the volume that you can build is not increasing because more people aren't buying, we see that people aren't overly buying at this point because they keep increasing the rates. So that's not sustainable. You're trying to stopping point, right? Back to Meta. Meta's phenomenal. Meta's going to be Meta, Microsoft, Apple, Google, Alphabet, right? These guys are always going to be the front runners. They'll be good indicators as to the economy. What it used to be back in the 1900s was we'd talk about industrial things, right? Textile, things like that. We just started to shift more toward computer chips and computer builders, Dell, Gateway, all that stuff like that. Now it's shifted into technology companies. So now technology companies, NASDAQ 100, that's giving you the indicator of how the economy is working. So I think people should start to focus on that. Also start to continue to keep your eyes on the components that make up what's building these computer chips. Precious metals, keep looking at commodities. I always preach this, but look at how those things intertwine. Oil prices, tech prices, see the way you're like, man, this is kind of, I don't know, these are kind of linked. This is correlating. So that's what I would say. And in that, that's my closing word.
Bippity boppity boo. All right, hey, perfect timing per the usual. So as we close out, guys, we hope you guys enjoy the show. We do this every Friday, 3 p.m. Pacific Standard Time. We are here on all of our Facebook pages, Instagram as well. Let us know what you guys think. Send us messages. Honestly, send us articles if there's something you think would benefit the masses as far as things to discuss. But other than that, gentlemen, parting words.
Mike Lumpkin and Denise, appreciate you guys commenting and chiming in.
Appreciate y'all. All right. We'll see y'all next week.